Hey everyone, and welcome. Today, we're cracking open one of the most important books ever written about money, The Intelligent Investor. We're going to distill Benjamin Graham's incredible wisdom and give you a real, practical guide for mastering the mindset you need to win at the long-term investing game. So to get started, I want to tell you a story about literally one of the smartest people who ever lived, Sir Isaac Newton. You'd think he'd be an amazing investor, right? Well, this quote says it all. Back in the 1700s, he got swept up in this huge market craze called the South Sea Bubble. He invested early, made a tidy profit, and got out. Smart. But then he saw his friends getting even richer, and FOMO, fear of missing out, kicked in. He jumped back in with his entire fortune right at the very top. You can guess what happened next. The bubble burst, and he lost everything. The key takeaway here? Newton didn't lose his money because he lacked intelligence. He lost it because he let the madness of the crowd dictate his decisions. And that sets the stage for everything we're about to cover. So here's our game plan for today. We're going to start with that emotional money trap that even got Newton. Then we'll figure out if you're acting like an investor or a speculator. And trust me, there's a huge difference. We'll introduce you to a character named Mr. Market, show you how to build a financial shield, and then give you a simple, actionable starter plan. And finally, we'll lock in your new investor mindset. Sound good? Let's dive in. So, according to Benjamin Graham, the reason most people lose money in the market isn't because it's too complicated. It's because they can't control their own emotions. It's that gut-wrenching fear when you see prices dropping, or that giddy greed when things are soaring. Those feelings lead to terrible decisions. See, the secret to intelligent investing isn't having a genius-level IQ. It's all about emotional discipline. In this game, your biggest enemy is often the person staring back at you in the mirror. This brings us to a really, really important question you need to ask yourself, and you need to be honest. Are you an investor or are you a speculator? So many people think they're investing, but what they're actually doing is just gambling. And figuring out which one you are is your first real win. So let's make this distinction absolutely crystal clear, because this is the foundation for everything else in Graham's philosophy. Okay, this is Graham's classic, famous definition. Let's just break it down into plain English. Thorough analysis just means you've actually done your homework on the business. Safety of principle means you've made sure you probably won't lose the money you put in. And an adequate return means you have a good shot at a reasonable profit. If you're missing any one of those three things, you're not investing, you're speculating. Simple as that. This really lays it out, doesn't it? The investor is all about the business itself. They're asking, is this company solid? Is it actually worth the price? They're buying a piece of a real business. But the speculator, they're just staring at the stock ticker, the little letters and numbers on the screen. They're asking, hey, is the price going to pop tomorrow? One is a business owner, the other is a gambler. And wow, is it easy to fall into this trap today? Buying some crypto just because the price has gone vertical? That's speculating. Jumping on a hot IPO and initial public offering just because of the hype without reading a single page about the company? Pure speculation. Buying a stock because your buddy gave you a hot tip? You know the answer. Look, the goal here isn't to judge, it's to get you to be honest with yourself about what you're really doing with your hard-earned money. All right, now for one of the most brilliant and useful ideas in all of finance. Graham created a little character to help us all deal with the market's wild, bipolar mood swings. Let's meet him. His name is Mr. Market. I want you to imagine you own a small piece of a business, and you have a business partner named Mr. Market. Now this guy, he's a little unstable. Every single day, he shows up and names a price. Some days, he's on top of the world, totally euphoric, and offers to buy your shares for way more than they're worth. Other days, he's in a complete panic, convinced the world is ending, and offers to sell you his shares for pennies on the dollar. The important thing to remember is that his price is based on his crazy emotions, not on the actual real value of the business. But here's the secret. Here is the whole trick. You are totally 100% free to just ignore him. You don't have to listen to his daily offers at all. In fact, the intelligent investor does the exact opposite. You use his moods to your advantage. When he's freaking out and offering you a bargain, you buy. When he's giddy and offering you a ridiculously high price, maybe you sell. His panic is your opportunity. Okay, let's talk about what Graham himself called the central concept of intelligent investing. This is your ultimate protection, your financial shield against bad luck, mistakes, because you will make them, and those inevitable market crashes. It's called the margin of safety. Okay, let's make this super simple. Let's say you've done your homework and you determine that the true intrinsic value of a company's stock is $100 per share.
But you don't buy it for $100. No way. You wait patiently for Mr. Market to get all pessimistic, and you only buy when the price drops down to, say, $70.
See that $30 difference? That gap between the real value and the price you paid? That is your margin of safety. It's your cushion. It's your buffer that protects you. So even if you were a little bit wrong in your analysis and the company was only worth $80, you still bought it for less than it's worth. This one simple idea is what separates smart investing from pure gambling. Okay, we've covered a ton of the mindset stuff. Now let's get practical. Let's build an actual, actionable plan for what Graham would call a defensive investor, which is just a great place for a beginner to start. First things first, and listen up, because this is the most important rule of all. It is non-negotiable. Only invest with your surplus money. This is the cash you do not need for rent, for groceries, for bills. It's money that if the absolute worst happened and it all vanished, your life wouldn't be financially ruined. Never, ever, ever invest your emergency fund or money you know you'll need soon. Okay, here are 5 simple steps. 1. Write down your own rules. An investment policy keeps you from making emotional decisions. 2. Invest the same amount of money on a regular schedule, say every month. This is called dollar cost averaging, and it's awesome because you automatically buy more when prices are low and less when they're high. 3. Build a portfolio of around 10 to 30 different, strong, well-known companies. 4. Check in once or twice a year to rebalance and make sure you're sticking to your plan. And 5. Just say no to the hype. Avoid those hot new stocks everyone's yelling about. The goal here is slow, steady, and safe growth. In that third point, diversification is so important. You've heard the saying, don't put all your eggs in one basket, right? Well, this is it. By spreading your money across different solid companies in different industries, some tech, some healthcare, some consumer goods, you protect yourself. If one company has a terrible year, it doesn't sink your whole ship. It's one of the best and easiest ways to manage your risk. Okay, let's bring it all home, because the real goal here, the whole point of Graham's incredible book, isn't just to give you a couple of tactics. It's to completely change the way you think about the market, about your money, and about your own behavior. Here's the most empowering truth you need to hear. Getting good results from investing is so much simpler than people make it out to be. Your success is not going to depend on your IQ score. It's going to depend on your emotional discipline and on having a solid framework, like the one we've just talked about, to guide your decisions. It's not about being the smartest person in the room, it's about being the most disciplined. And we're going to end on this incredibly powerful quote from Graham himself. In today's world of nonstop hype, social media noise, and market madness, this idea is your anchor. You're not right because 1,000 people on the internet agree with you. You're right because you did the work and your reasoning is sound. Your own clear thinking is and always will be your single most valuable asset.